Tonight, we're going to do something a little different. Instead of staying high level, we're going to get very current and very specific. We've just closed out the first quarter of 2026, and it gives us a clean moment to step back and assess exactly where we are. What I want to walk through is what's happening with housing inventory across the country, how it's evolving, where it's normalizing, and where it's still structurally out of balance. These are intended to be more candid, even confidential level observations based on what we're seeing in the data right now. For those I haven't met, my name is Steve Colino, and this is a special confidential remarks. And what I'll show you is that while the headlines suggest recovery, the reality underneath is much more nuanced and much more strategic. This chart shows the full arc of the housing inventory cycle. We peaked near 1.1 million listings pre-pandemic, then collapsed to just over 350,000 during the 2022 trough as the market overheated. Since then, inventory has been steadily rebuilding, crossing 560,000 in 2023, nearly 900,000 in 2025, and now approaching 1 million in early 2026. At the current pace, we're on track to fully close the gap to pre-pandemic levels by 2027. But the important nuance is that this recovery is not linear. It's slowing. The acceleration phase is behind us, and we're now entering a more measured normalization. Since the 2021 to 2022 peak, we've seen a clear directional shift in market power. What was once maximum seller leverage has steadily transitioned toward balance, and now, in many markets, toward buyer leverage. March 2026 marks a pivotal point in that transition. However, this is not a wholesale flip. What we're seeing is normalization of extremes. Previously, overheated markets are correcting back to balance, while previously stable markets are beginning to tilt toward buyers. Even with inventory rising, the pace of softening is slowing, and home prices nationally remain relatively firm. So this is not a collapse, it's a controlled rebalancing. And national average obscures what is fundamentally a bifurcated market. In the Sun Belt and parts of the Mountain West, inventory is rapidly approaching or even exceeding pre-pandemic levels. These markets are absorbing the impact of stretched affordability and a surge in new construction. In contrast, the Midwest and Northeast remain structurally constrained. Limited new supply continues to support price stability in those regions. So while one side of the country is softening, the other is holding firm. Understanding this geographic divergence is critical because it drives entirely different investment and operating strategies. When we break this down diagnostically, the contrast becomes even clearer. In the Sun Belt and Mountain West, inventory is nearing or exceeding 2019 levels, price growth is softening or declining, and new construction is exerting significant downward pressure. These markets are decisively shifting toward buyer leverage. Meanwhile, in the Midwest and Northeast, inventory remains well below historical norms. Price growth is still resilient, and limited new supply is preserving seller leverage. So we are effectively operating in two different housing markets within one country, one correcting and one constrained. A group of 12 markets is leading this correction. These are markets that experience massive pandemic-era migration and price surges that detach from local income fundamentals. As migration slows and mortgage rates remain elevated, those fundamentals are reasserting themselves. The result is a sharp and ongoing inventory correction. Cities like Punta Gorda and Austin are prime examples where active listings have ramped quickly. These markets are not just softening, they're resetting to more sustainable pricing relative to local incomes. This is the mechanism driving much of the shift. High mortgage rates initially strained affordability and slowed resale demand. Builders responded by aggressively using margins to offer incentives and rate buydowns. Buyers who would have purchased resale homes pivoted to new construction instead. That diversion of demand has pushed resale inventory higher and kept listings on market longer. The result is a feedback loop. More inventory leads to more pressure, which leads to further adjustments. In the Sun Belt especially, new construction is actively cannibalizing resale demand and accelerating the cooling process. The scale of builder intervention is significant. Average incentives have increased from roughly $17,000 in 2022 to over $62,000 in the past year, a more than 260% increase. Builders like Lenner have led this shift, aggressively protecting transaction volume. For investors, this changes the underwriting equation. Whether you're in build to rent or single family rental, you're now competing against deeply subsidized new construction. That means resale pricing and exit assumptions must be adjusted accordingly. We're now seeing a divergence between supply and transaction activity. New listings are rising sharply as the lock-in effect begins to ease. Homeowners are finally re-entering the market. However, that increase in supply is not translating into a proportional increase in closed sales. Transactions remain constrained. This creates a bottleneck effect, where inventory accumulates faster than it clears. The implication is clear. More listings alone do not mean a healthier market. They can also signal growing friction. Florida provides an early signal of where things may be heading. After being one of the weakest markets over the past 2 years, inventory growth there is now decelerating, down 8% year over year. What's notable is the timing. This slowdown is happening during Florida's peak seasonal period, when inventory typically surges. Instead, we're seeing an unusually muted increase. That suggests the correction phase may be entering a new stage, not just expansion of inventory, but stabilization in the rate of change. Looking ahead, 3 strategic themes emerge. First, acquisition strategy must be region-specific. The Midwest and Northeast offer pricing resilience but limited deal flow, while the Sun Belt offers volume with higher risk of continued softening. Second, builder competition is now a defining force. Incentives at scale are reshaping rent versus buy decisions and compressing resale values. And third, the macro outlook points to continued geographic fragmentation. National rate movements are becoming less important than local income-to-price alignment. Markets that overshot during the pandemic will continue to correct, mechanically and persistently. This has been Confidential Remarks.